According to one model, the probability of a recession in the next 12 months has risen to above 50-50. And Kyle Bass, Heyman Capital Management founder, is singing the same tune.
I think economic activity will begin to wane in the back half of 2019, and by the middle of 2020, we're most likely to be in a recession.
Well, joining us now, Linda Duessel of Federated Investors. Linda, we know we're going to disagree with that because you could have your base case 3,100 at the end of the year for the S&P. What's going to change for you?
Well, 3,100 S&P by the end of the year indicates that the market has agreed that there is not a recession on the horizon. And, you know, if we make our way through August of this year, it will be the longest economic recovery in the history of this country. So it's hard for market observers to believe that it can go on and on. But we at Federated believe that this will end up being the longest and continue to carry on in terms of an economic recovery. That sets our bullish view. It is a secular bull market. It is a long-term buy and hold bull in our view.
So from the business side, the indicators are not that positive. The PMIs and also the CapEx, things like that. Is it the consumer that's going to pull us through? Is the consumer strong enough to pull us through?
Yeah, well, yes, the CapEx is the big question. And we really are rooting for CapEx to pick up here as we make our way through the rest of this year, after it got really abbreviated last year with energy prices coming down hard and then concerns from corporate CEOs about what's going to happen, you know, the very bullish view. But I think we forget the fact that we were at all-time record highs in confidence in both consumer and business just as recently as July of last year. So yes, we're coming off the boil, but that does not mean that we're careening into recession at any time soon.
So what we've seen over the last few weeks, say, is you have a dollar rallying, even though the Fed's dovish. You have industrials rallying, even though we're worried about a China slowdown. As you can see in my chart, small caps rallying despite us being late cycle. Is that the right trade then? I mean, is it buy dollar, buy small caps, buy cyclicals? Is that what you want to be doing?
I know if you're a student of history and you say, well, where are we in the cycle? We really believe we're in the back half of a cycle. And if you look at history, that says, then I ought to move up market cap. I should focus on the United States of America. I should buy stable growth. And we like all this very, very much. But where we stand now, I mean, with regulations being cut dramatically, with money fairly easy, and the economy still growing, small cap stocks look great too. It's a crazy thing. You know, sometimes I think you might as well throw out the book we studied all those years for the cycle, because this one could go on, and we like small caps a lot here.
Linda, inject one more thing, and that is the dollar that Alex just referred to. The strength of the dollar. I'll put a chart up that shows how strong it's been since the Fed said they weren't going to be raising rates anymore. Given how much of the S&P 500 actually get their earnings from abroad, what do you need to happen with the dollar? A strong dollar does not help those companies in their earnings. What do you need to happen with the dollar for your prediction to come true?
Well, we really would like the dollar just to stabilize here. I mean, the dollar's been extremely strong. I know people are suggesting that it will start to weaken now that the Fed has come off the boil, but you still have countries, central banks, I should say, around the globe, just printing and printing away. That would argue that the U.S. dollar stays stronger and we don't have it come crashing down. You don't want it to go either way. You don't want it to be too strong and you don't want it to be too weak. If it could stabilize here, that would be just fine.